There are a number of factors that drive business value, and I particularly want to talk about e-commerce costs because we're in the holiday season and a lot of e-commerce companies are out there selling. So here's some examples. Customer acquisition cost, or CAC, is the cost to acquire a new customer. And you can think of it as sales and marketing expenses divided by the number of new customers you acquire. And obviously the game plan is let's try to minimize the numerator, sales and marketing expenses. Let's try to maximize the denominator, which is the number of customers. That's CAC. Monthly recurring revenue. What is the predictable expected revenue that you can expect each month? The best example is subscriptions. Think about your Netflix subscription. That drives monthly predictable revenue for Netflix, as opposed to waiting for customers to come in your store periodically. That's different. We're talking about monthly recurring predictable revenue, which is normally subscriptions. So MRR, you can think of as the number of customers times the average revenue per customer. So if you're Netflix, you have X amount of people paying $8.99 or some amount for Netflix, monthly recurring revenue. Churn rate, you can think of as turnover rate, which is the percentage of customers who stop doing business with you in a year. And this is a huge issue for SaaS, software as a service companies. The best software as a service companies, SaaS companies, still have maybe 5% turnover every month, which times 12 is 60% a year. So turnover can be very high for these SaaS companies. And what does that mean? You have to go out and replace those customers. When you replace the customers, you have to spend more in sales and marketing, and you can see how the cycle happens here. So the idea is to maximize monthly recurring revenue and minimize the churn rate. And minimizing the churn rate is very tough. Even really good SaaS companies and subscription-based companies like Netflix have a fairly high churn rate. Some other factors that drive value, and we're to this point with Netflix, and another example that I use is Apple, brand recognition. So the higher your brand recognition, the more likely that when somebody needs to buy your product or service again, they're going to go to you rather than their competitors. They're going to go to you because they recognize and trust the brand. I'll use myself as an example. I have a MacBook, I have an iPhone. I'm not switching away from Apple for my phone or my computer ever again. I'm satisfied, I'm always going back. Brand recognition. And the last one I'll talk about are innovation, because if you run a good company, people are more likely to try a new product that you produce. So Panera, for example, is changing their menu. People are more likely to trust you and try your new product that you come up with innovation.